Celsius Holdings is up now over 12% after reporting their earnings this morning, and we're going to do a deep dive into some of their phenomenal earnings. We're going to see whether they are still a company to buy now with some incredible growth over the future. This was one that I did bring to my followers around 3 months ago, as we can see here, talking about how this could possibly be one of the best growth stocks to buy now. As we can see here, this was just before it was trading at a 3-to-1 split. So at this point, if we're comparing like for like, it would have been around that $52 mark. Currently trading at over 50% gain if you had bought that around 3 months ago. So as always, we're going to take a look at this company. We're going to take a look at their income statement, their top line revenue growth, as well as their bottom line net income. We're going to see the complete health of the company, a quick look at their total cash versus total debt. We'll also see if they've been outperforming some of their competitors in the local market. We want to see what institutions are doing, if they are still buying or if they have started to sell on these increases to the price. We'll also discuss some of their positive financial metrics, look at some areas that could be a cause for concern in the future, and we'll discuss some insider selling that we have noted quite a heavy amount over the last few weeks. And what we're going to really do is focus in on their report to see how well these numbers were. As we can see, the markets have loved that with their reaction. And we'll see what is their intrinsic value, what is their acceptable buy price, do we still have a margin of safety, and what are Wall Street now forecasting for the next 12-month period. So let's jump straight into this company. Now we can see it is fluctuating a fair amount, however it is up very strongly. Over the last year, up 124%. That is absolutely incredible, even just over a yearly performance. Over the last 10 years, if you had bought this in around 2019, 2020, around the $1 to $2 mark, you would be up over 36,000%. Absolutely phenomenal. It is currently trading now at the 52-week high with a forward PE getting into nearly the triple digits at around 89. Market cap around 15.7 billion. So let's first jump into their results to see how well they were. Record fourth quarter revenue of 347 million. Absolutely phenomenal, given this is up 95% from the same quarter in 2022. Their full year revenue now recorded at 1.3 billion, and this is up more than double, up 102% from the full year of 2022. So lots to love here. We can see that their revenue in totality, the numbers here quarter on quarter, but we see a large jump in the last quarter in North America on both the quarterly approach as well as the yearly approach of over 105%. On top of that, their gross margins have improved very strongly, up 340 basis points to 47.8% versus last year's same quarter of 44.4%. So lots of positives to note. Their quarterly EPS diluted is 17 cents per share. Previous quarter, well, it was a net loss, in fact, of negative 12 cents. And when we compare the full year, 0.77 versus last year's of 0.88, lots to love here. Not just increasing their top line, but also bringing that earnings per share from a negative basis to positive. Now, for those that prefer to see graphs to see the growth, we can see some very strong growth over the last few years, as well as a quarterly approach. Although we do note, comparing it to the previous quarter, it has dipped slightly. But again, we will touch upon that when we do talk about the financial metrics and sustaining that long-term growth. Now, in terms of actual numbers over the longer term, well, what we can see here, December 2018, 53 million on their top line. Now, remember, yes, typical companies, we're looking 3 to 7%, but when we look at these growth companies, we do have some high expectations. They've increased that from 53 million, as we saw in their December 2023 of around 1.3 billion. And we can just take a look here just to confirm that as well. 1.318 billion. So absolutely phenomenal. That has increased very, very strongly. And on top of that, what I do like to see is that year-on-year increases. We don't see any years where there are any stagnations or any drops. And the bottom line, we can also see negative 11.2 million in 2018, whilst they have struggled year on year, and in their more recent year at negative 187.3, we do see now that they are having a bottom line net profit, turning it from a loss of 187.3, when we take a look here for the net income attributable to common shareholders for the full year FY 2022, 182 million. So lots of positives with this company. Not are they only just growing their top line at a very fast rate, but in the previous year with that net loss, they have turned that into a strong net income. Now, one thing I do love about this company is the strength of this balance sheet. Now look, quick health check, cash versus total debt. It's gone from 8 million in 2018 to 760 million in their latest report. Now look at this, their total debt, absolutely phenomenal. It is very, very small. It was 8 million in 2018, now sits around 1 million. So they have a ton of cash in comparison to their total debt. And if they wanted to, it wouldn't even take them one day to pay it all off. Now we have a few other companies in the soft drink and non-alcoholic beverages company with a fairly similar market cap. In terms of the performance, well, CELH, as we can see, the best performing over the last year, quite significantly as well. And when we incorporate the 5 years, what we can see, 6,337%, absolutely blowing out the competitors out of the park. Now remember, past performance is never an indicator of future performance, so something just to keep in mind. Institutional ownership, 60%, 496 million worth of outflows by these institutions over the last 12 months. A lot more buying, just under 3 billion, 2.7 over the same period. Institutions do quite like this company, and we can see pretty much every single quarter over the last few years more buying than selling, other than in fact quarter 3, and in the latest quarter a big order, 2.19 billion. So we can see not just over the last 12 months but also over the more recent quarter, Q4 of 23, institutions are loving this company. But it's important, as I always say, because it is very important, always do your own due diligence and never just go off what the institutions do. As always, transparency, we want to take a look at both insider buys and sells. We want to be a bit more relevant. So over the last month, what we see is a lot of selling by the owners. We have here, as we can see, they are 10% owners, and they are essentially the last day in January and the 2nd of February. Now, in total, we can see these are very large orders, but one of the reasons why we always say on the channel insider selling is never a bearish signal is due to the fact that they sell for many reasons. They could be private reasons, financial reasons, personal reasons. And also what we really want to draw out from here is even since selling, the share price has rocketed between 50 to 56%. So never really rely on this as a bearish signal. On the other hand, if we were to see insider buying, we would say that is a very strong bullish signal, as insiders do buy for the reason that they believe the share price will go up. Now, before we jump into the metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as other articles completely free, all you need to do is click on that pinned comment below. Now, free cash flow per share is what I always draw your attention to over earnings, as it is susceptible to manipulation by management through accounting. So on the free cash flow, we can see over the longer term, it did have a negative free cash flow per share. And we did see on the graph, it was trading at around $1 to $2 around this time. 2022, they had 39 cents of free cash flow per share. 2023, we do see it dip, although in 2024, it is expected to skyrocket, in fact, to around $1.06. So we would say here a very, very large increase, and we will factor this in when we look at our discounted cash flow model valuation shortly. Sales growth very strong, as we saw there, 98% in 2023. And in fact, what we typically see from growth companies is the opposite, where they have very, very large growth at the early ages of the 10-year period, and it starts to come down. With Celsius, it looks like that rocket ship of growth is just starting up. Double digit every single year. The last 3 years, absolutely phenomenal. And when we look at this numerically, they've gone from around 10 million in 2013 to around that 1.3 billion that we did see in their presentation. One thing to bear in mind, those shares outstanding, they do dilute your position over the longer term, increasing those shares outstanding from 60.5 million to 234. But as I mentioned regularly, when companies do this, yes, it is a bit of a red flag indicator. But when you take a look at a company like Celsius, with their share price has been increasing rapidly, this wouldn't really be a worry at all. So always bear in mind, if they do dilute your position, have to look at whether or not it is worth it as an investor and what you are sacrificing. ROIC then, due to the fact that they did make a loss during this period, as we can see, we do note the negative ROIC figure. In the more recent year, 2023, at around 17%, is very nice to see. As always, I personally look for 10% or more to give me faith that management are able to effectively allocate their capital. Now, we do see they have been struggling for quite some time, and again, this is what I have been saying when analysing those growth stock companies. You do want to be looking at companies that are just turning from a negative to positive, as that is where the real play is in terms of the growth. We do note now in 2023 that 15% positive operating margin is very nice to note. But then again, do bear in mind they did see positive in 2020 with the following 2 years a negative margin, and a very similar story on the free cash flow margin. So what I would quite like to see here is a couple of years of positive margins on both the operating side as well as the free cash flow margin side. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. As always, this does show us the balance sheet strength of the company. And as we mentioned on the balance sheet review, it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. So let's jump into the valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, on the channel, we do typically run through a few different models. However, for Celsius, the only one that we do deem to be relevant is the DCF discounted cash flow model. We have the free cash flow where we did see it turn negative, although the last 2 years have been positive with some nice growth. Now, forward looking, we have gone for 20%. Now, this is lower than analyst targets and lower than what we see management expect. So we have been a bit more conservative. With our discount rate of 8%, we do get to the present value of future free cash flows and terminal value. Add it together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see our intrinsic value, and we have a sign of undervaluation. Now, be understanding that this number here, the growth rate, is fairly subjective to each investor, and we have tried to be more conservative. If you are of the frame that over the next 10 years and beyond, they will be able to grow at an even faster rate than 20%, all you would need to do is change the numbers in here. And we can see at a 30%, it changes the price drastically to 218.71. So again, it does come down to the individual investor. And as I always say, if you do want to grab a copy of this valuation model so you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or in your watch list, you can grab it by clicking on the pinned comment below. So with our intrinsic value at 114 and a margin of safety, we always start off with around 10%, and we use that if we believe it has a wide moat, strong financial metrics and good forward-looking data. And we pretty much go until it's near the current trading price. And as we can see for today's episode of Celsius Holdings, it is around a 30% margin of safety up to around $80. Now, yes, it has grown very rapidly, and a lot of this price really does come down to the future, what you believe their growth rate will continue to be, and whether or not you do see this as sustaining their top line growth, as well as turning their bottom line into a profit and having this consistently over a longer period of time. In terms of Wall Street and their price target, well, they have around $80, so they do see upside around 4% over the next 12 months. But again, as I always say, Wall Street's forecast, if the share price continues to increase, they will revise this and they will also increase their price target. So what's important is you do your own due diligence, come up to your own margin of safety and intrinsic value, and derive from that what you are looking for the longer term, whether or not you see this company continuing to grow. They did have some absolutely phenomenal numbers in this earnings report, and if it can continue, then again, this still could be a very cheap price for Celsius for the future. As always, I'm interested to hear your thoughts, whether or not this is one you're adding, whether this one you've been holding for a long time and you're just sitting on the sidelines, maybe adding if you see another large dip. But as always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, have a great one.